This is our ultimate balance play for this particular part of the show because we've got some more positive, bullish elements coming from our macroeconomic analysis just now in the last 5 minutes. And we're coming in with Ivory Johnson, and you're not quite as optimistic. Tell us why.
Well, if you look at, for example, the GDP numbers, it was outstanding, over 3%. But there's something called the deflator because it's inflation adjusted. They didn't use the CPI numbers over 3%. They used 1.3%. That actually increased GDP growth by 200 basis points. We're having this discussion about when the Fed will cut interest rates because that started, I guess, in November when CPI came in lower than expected. But what is behind the scenes, what you'll see is that, the CPI numbers assume that healthcare premiums declined by 30%. And so I tend to, I believe in making the main thing the main thing. These numbers are good, but, GDP growth, 17% contributed by the federal government is what's normal. But this time in 2023, they contributed 30% towards GDP. New hires, normally it's 6%. That was 22 and 21. Last year, they contributed 2.3% because the government spent, an extra $2.5 trillion, put that on the balance sheet. That's 3 times what we spent bailing people out in 2008. I don't know how sustainable that is. And so I'd be more likely to look at, are companies making money? 40% of Russell 2000 companies have negative earnings. You take out those 7 stocks, the magnificent 7 stocks, the other 493 stocks had negative earnings growth, had negative income growth. So, it remains to be seen if the economy is going to recover and be able to sustain itself without the government spending.
Ivory, the Magnificent 7, or even before they were Mag 7, were still the driving force behind the markets and the driving force behind why the markets kept going higher. And maybe even arguably the reason why there was an economy that never went into a hard landing scenario. If you feel as though the other 400 and some companies are more indicative, that would have been the case the last 6 or 7 years, right?
It would have been. So that's why these job numbers are so important, because you've got systemic order flows. You got $460 billion, according to Vanguard, that's going into the defined contribution plans. And so 30% of the S&P are these 7 stocks, and 70% of those that flow is going into the S&P, is going into the stock market. You have a concentration of money going into these companies and creating buy-side pressure. The other thing I'll mention is now you have 0 days expiration options. That's probably close to 50% of the S&P 500 options volume right now. That was much lower a few years ago. So you're talking about $1 trillion in notional value every day being traded in these 0 day expiration options, which forces the other side of the market, the person who took the premium, to hedge their portfolio. That creates buying pressure. So again, it's not 2 years ago. It's now, and I'm still interested to see how all these things will play out.